G'day fools, Scott Phillips here, the Motley Fool's Chief Investment Officer in Australia, and welcome to another in our, well, I say it every week it's true, our ever popular feature series, Stocks in Focus, where we bring you our views on some of the companies that we don't necessarily have as buy or hold recommendations, but we know are very popular in the news or simply you want to hear about. We have in the past taken your suggestions. If you do have any, by the way, hit us up on social media. I'll give you those details in a little bit. Hit us up on social media. Let us know which companies you would like us to cover. Because frankly, we're here for the viewers. If you're not watching, it's not worth our time. On the flip side, if you are watching and waiting for your stock to be covered, well, this is the best way to get in touch. So jump on the socials. I'll give you those. Grab a pen, grab a piece of paper while you listen to the great insight about to come from one of our favorite analysts. They're all our favorites, let's be honest. One of our favorite analysts, Ed Vesely. G'day, Ed. How are you, mate?
Yeah, very well, thanks. Scott, thanks for having me on today.
Pleasure, mate. Thank you for joining us. Now, let's drag the curtain back just a little bit. We're recording this on Monday, the 27th of September, and Ed is actually supposed to be on holiday. So there you go. That is Motley Fool commitment. That is Ed Vesely commitment, straight from him to you. He could have swapped it. He could have said no, but no, he's here on Monday morning. How good's that? Waiting to start his holidays. The kids in the background desperately waiting to say, Dad, take us out. But before he does that, he's here for a Stocks in Focus episode, especially for you. So hope you appreciate it. Ed, you are going to cover a company that I reckon, well, I guess lots of media, but maybe not even as much as it deserves. You're going to talk about Fortescue Metals. Now, Fortescue, I reckon, is one of the great Australian success stories of the last, I'm going to say 50 years, just to pick an arbitrary time period, probably even longer, from someone to be able to build a world-challenging, world-beating, world-class company on the scale of Fortescue is remarkable at any time, let alone one that's incredibly capital intensive as Fortescue is. When you can kind of go from zero to competing with BHP, Rio, Vale, the Brazilian iron ore miner, a generation quite literally, right? Twiggy's no longer directly involved, Andrew Forrest, of course, but he's built this amazing organization. Whether or not it's a good investment, we'll get to in a little bit, but I just reckon as one of those kind of, Australian success stories, businesses we really should be venerating. We talk about the CSLs, we talk about our banks. They're great businesses, of course. There's plenty of others Afterpay, possibly joining those ranks if it can deliver some longevity. But Fortescue, I think, mate, one of the best of the last 50 years. Would you agree?
Yeah, the returns have been amazing. I mean, It's a fascinating company as well for everything that you've just, all the reasons you just said. It's basically been started from scratch and it's now competing with the likes of Vale in Brazil and BHP and Rio Tinto. But it really is a one-trick pony in a sense because it has one product and it sells it to predominantly one country. So I'll discuss that. But,
yeah, let's do that.
Sorry, I was going to say too, look, it's been in the media quite a lot. And it was a few weeks ago when we decided on this discussion of Fortescue. I thought, well, that's a good one to look at because the iron ore price back in late July when I guess I decided on the discussion of the company was that the prices then were over $200 a tonne. And I looked at the price just yesterday and it's fallen to around $109 a tonne. So it shows you how volatile it's the pricing of its core commodities are. That's actually seen also a share price fall from around $26 to $15 today. That's down 43%. But looking at the context of this, it's still well above the $4 it was back in 2019. And I think going back a couple of decades, you could have picked this up for a few cents. So, but there's a lot of risk.
If only, mate. If only.
It's not something I've picked myself.
Me either.
Look, it's a company that's most people would know. It's based in the Pilbara region of Western Australia. It very simply just digs iron ore out of the ground. It's got some amazing infrastructure. 760 kilometres of company-owned railroad, which it uses to get its trains to take the iron ore to Port Hedland, and then on it goes to ship to overseas customers. So that's what it does in a nutshell.
It's incredible, mate. 750 kilometres, let's use the actual numbers, of rail track. That's going to take you most of the way from Sydney to Melbourne, most of the way from Brisbane to Sydney. And that's just purely, A, it's company owned, as you say. B, it's all in service of iron ore. We know recently, by the way, and this is not only is Fortescue competing in terms of just simply in the same industry, but it is either the lowest or one of the very lowest cost producers. I want to say last time I saw the numbers, mate, it was a cash cost of something like $15 a tonne out of the ground. If you think about a tonne of iron ore, and imagine having to go to the entire process of buying the machines, digging the holes, getting the ore out, crushing it, refining it, getting onto a ship. for a ton of that, think about a ton, 1,000 kilos, you do that for $13. It's man, I think that's the cost of a bottle of Evian water these days. It's an amazing story. They do a remarkable job of doing it. And as I said before, mate, that meant gross margins, at least cash margins, of 95% odd. That's better than software. For all of the talk we say about capital light businesses and all that kind of stuff, for quite a few months there, Fortescue made even software companies look pretty pale by comparison. It's been a phenomenal run. I guess, and look, Twiggy got, I think, a $2 billion dividend from memory last time the dividends were paid. So he's doing all right. He's not going to struggle for a bite or a drink anytime soon. Tell us the Fortescue story as it exists today, mate. Obviously, as you said, we've gone from $220 a ton to 109. There's your US dollars, of course, by the way. Over that time, the share price has also fallen, but still up, as you say, almost fourfold on 2 years ago. It's a really volatile space. So tell us about the company, tell us about the commodity, and then tell us what you think about the investment.
Absolutely. Look, I've been looking through the most recent financial results. Look, what it's done is it's increased its iron ore production by 2%, which doesn't sound like a great deal, but it produced just over 182 million tonnes of iron ore for the last 12 months through to the 30th of June.
Million tonnes, 102 million tonnes. That's phenomenal.
Yeah, million tonnes.
Yeah.
And you mentioned the margin. Look, the figure I've got there was $13.93, that's US.
There you go.
That's the cost. So the cost of getting it out of the ground, getting it onto trains and shipping it off overseas. Now, the average revenue per tonne for the financial year was $135, but as we've seen, the iron ore price has been over $200 recently. It's sitting at around 109. It's moving up and down quite a lot. Its EBITDA margins too, not quite as healthy as 90% or so, but still averaging 73% for the year. Amazingly too, it does have a bit of debt. Yeah, all these figures are US dollars again, but look, the $4.2 billion it has in debt is more than over compensated for by the $6.9 million in cash, again, US. And its debt maturity profile is pretty good too. It doesn't have any major debt covenants coming up or any major debt rollovers coming up in the next few years. So it's looking good. It's got a fantastic margin. Its net profit after tax was US $10.3 billion. Now, if I look at the earnings per share, I've got $3.35. If I just convert that to Australian dollars and cents at the moment, I get if I just use, say, 73 cents at the current currency, this comes to around $4.59 per share in trailing earnings per share, which gives us a price earnings of around 3.3 times. So for a company with really good, it is. It's got amazing revenue growth right now. It's got fantastic profitability, high margins, and yet it's trading at 3.3 times its trailing earnings. So the question is, would we buy it? It sounds like an absolute bargain.
I'm going to stop you there, Ed. I'm going to stop you there because I'm going to get you to go through the bull case and then the bear case separately. And I don't want you to give away the answer just yet. Okay. So if I was going to make a case, if you're going to make a case, say to me, Scott, I'm banging the desk here, I'm banging the table, you've got to buy shares in Fortescue, and here's why. Make the bull case for me. Convince me to buy shares in Fortescue, mate.
All right. Well, look, it's very healthy. It's got a very healthy balance sheet. It's obviously performing very well. It's got high inside ownership. You mentioned Twiggy Forrest, Andrew Forrest, who collected, it was actually just under $2.4 billion as a dividend. The dividend itself has risen from 5 cents per share in 2015. That quadrupled to 23 cents, more than quadrupled to 23 cents in 2018. And now we're sitting at $3.58.
Oh dear. That's a lot of cash.
Yeah, just as a fun fact too, the franking credits attached to that dividend are just over $1 billion for Andrew Forrest. So he's doing all right, isn't he?
Yeah, he's probably doing okay. I didn't think about the franking credits. You're right, actually. What do you do with that when you franking credits? I suppose you go and, I don't know, buy a boat or something, do you?
Oh, well, a boat or a boat industry maybe.
A small country, yeah.
But he's doing okay. I mean, he's created the business. The bull case is that, look, the financials look really good. The balance sheet is great. It's actually operationally doing very well. The bear case, I think, with Fortescue, you can't just look at the company in isolation. Right. You've really got to consider what's happening in the global environment. And of course, I mentioned earlier, it's more or less a one-trick pony. It sells iron ore. It does have some other services revenue on the side, shipping and some other smaller bits and pieces of revenue there, but it's not material. it actually exported, or it actually created revenue of 22.4 billion US last year. That was up 74%. But you shouldn't necessarily think that's going to continue. 90% of that demand came from one country, so that's China. So when you're really looking at the opportunity in the shares right now, Scott, you've really just got to consider the risk reward of dealing with China in the current climate. And I'm not just talking about the economic climate, but also the political climate. China does seem to be having I guess a bit of what would you say? There's some sanctions going on. Look, it's not happening with iron ore at the moment, but it could happen in the future. But what we do know is that this is what's happening right now. I think the economic story out of China is probably a little bit more important than the perceived political risk. Right now, there's steel output curbs in place in China, and I think if you're being a little bit cynical about it, you could just say that they're doing that because they know the Winter Olympics are happening next year and they want to have clear skies. They're also looking for lower carbon emissions generally. But what's happening right now in China is that you've got slumping construction output data, which shows home sales are falling or have fallen by around 20%. And of course, that's going to have a flow-on effect to the demand for iron ore. And you just have to look at the Evergrande story in the media at the moment, where it's becoming more obvious now that bad debts are making their presence felt. Look, China being basically the one country that it exports to, you've just got to look at the fact that China has a GDP, it's looking at, real estate as maybe making up almost a third of its GDP is what I'm trying to say here. And so the property sector in China is actually critical to the demand for iron ore going forward. From what I've read online, and I'm looking at sources like the Financial Times and other newspapers, housing starts are now expected to fall by up to 30% next year in 2022. And that could see a flow-on effect to iron ore consumption of up to 12% drop, which is going to obviously have a big impact on the likes of Rio, BHP, Fortescue. So real estate could actually prove to be a drag on growth in China going forward rather than a boost or a driver. So look, I just think the risks are quite high. It's a one commodity product. Look, they might be talking about hydrogen and other things in the future.
They are, yeah.
It doesn't trick anyone right now. That's way off. I think what you've got to look at is right now, would I be a buyer? I wouldn't probably. I think the price of iron ore is volatile, but it's probably trending down. China is definitely slowing, and you've got long-term forecasts of GDP growth in China are falling to as low as 4%, say, in the next few years, and then as low as, say, 1% to 2% by the end of the decade. So whether that happens or not, we'll have to just wait and see. But I think the risks are to the downside right now. So the bull case is one thing. It's a great, it is actually a great company. Has only one product, but it has a very good balance sheet and is certainly managed very well. But you've just got to look at the wider picture. There's a lot of reasons why I invest in it. I could go on, Scott. Do you want me to?
Let me throw devil's advocate at you first, and then we'll bring it to a head. 3.3 times earnings, I think you mentioned. That's plenty. A, maybe the market's already factored that in. B, there's plenty of upside there. C, there's plenty of cash in the balance sheet. Is it possible that even despite those headwinds, mate, it gets too cheap to ignore? At what price does it get too cheap to ignore, given it's producing iron ore at $13 US a ton, selling it for something north of 100, even if it was 80 or 50 or 60, still making $1 squillion and really high gross margins? I'm curious as to, not necessarily have to name a price, but how do you think about that? Because obviously there are those near-term headwinds. I would assume, I don't know, long-term, I would assume iron ore continues to be in demand in some way, shape, or form. Maybe Twiggy gets the hydrogen stuff done, and it's 3 times earnings. Is that not enough to tip the balance the other way?
Well, I think iron ore is the driver of its earnings right now. It's going to be that way for some time to come. You're looking at earnings from its operations as being, I think, at historically high levels. So the price earnings, it's a ratio, right? So it's either a very low price or very high earnings. It could be a bit of both, but the earnings are very high. What I would rather see is there being a good time to buy a company like this is after there's been some sort of collapse in demand for iron ore, which sees revenue fall, which it probably will at some point. And then you're going to see a much higher price earnings ratio. It might actually be better to buy it when the ratio is actually a higher and in advance of the next recovery, whenever that might be down the track. One thing to consider too is we spoke about the Brazilian company Vale. Its reliability of supply is very uncertain at this point, and that's actually also been a big boost to Fortescue's operations. you probably could read it in the media. There was a dam disaster in 2019, and that's actually, not to mention, it's had a very bad flow-on effect to farmland and a local village which got wiped out. But the supply of iron ore has been very uncertain for the likes of China, so they've had to rely on Australian ore. China relies on, in terms of all of its iron ore, it's actually taking 60% of its iron ore from Australia, and from China's point of view, that's a glaring vulnerability, I think. So what they're doing, sure, there's the Brazilian Vale on one side of it, which is actually possibly a benefit to iron ore and the likes of BHP and Rio Tinto. But on the other hand, you can also read too that China is actually pushing quite aggressively into building a new, I guess it's like a mining hub in Western Africa. And the Simandou mine is a good example of that. What it's expected to achieve is around 2.4 billion tonnes of grading at 65% iron metal, which is extremely high. And for context, Fortescue Metals reserves are at 2.8 billion tonnes. So it's actually very similar. So they could easily replace, not that they're buying all their iron ore just from Fortescue, but they could easily replace that. But here's the thing, with Simandou, which is going to cost a huge amount of money to the Chinese, the return on investment isn't necessarily going to be the driver of getting that particular iron ore hub up and running. So they're going to be looking at the political, they're going to be looking at the strategic, and just in terms of the long-term position of China, and I suppose the perceived risk that it has in dealing with Australia at the moment, if you're looking at it from their point of view. So I think given these longer-term risks and rewards, you'd really be looking at buying into Fortescue possibly as a speculation and as a very small part of a portfolio. But personally, I wouldn't be buying it. But that's me.
Very good. So I'm going to suggest... Go on.
Yeah, there's a lot of things that can go wrong. Hey, we talked about the low valuation. You could look at it from the dividend yield. At the current dividend now, it's got a 23% dividend yield.
It's astonishing, isn't it?
Frank, it is astonishing. And look, even if it cut its dividend by 75%, you're still looking at 6% or thereabouts, which is still very good, right? But of course, if
it's worth saying too, mate.
Cut,
yeah,
if you saw that, there'd be a massive decline in revenue and hence maybe the share price.
It's a reminder too that if you look at where the share price was, as you mentioned, I think it went from 26 to 14, if I remember you rightly. Even though the dividend yield was 23%, even on the current price, the dollar value of the dividend yield is actually less than the fall in the share price. So it's always nice to get that. But if you paid $26, you got paid $4 in dividends. You'd expect the price to fall about 22. The fact it's fallen further means even with that massive, massive yield, I'm going to say reasonably, I can't remember the last time we had a yield that big for any company, certainly not a big one, mate. So probably almost unprecedented yield for a large Australian business. Even despite that, the share price is still down, even allowing for that dividend. So it's just a reminder, even with franking credits, just a reminder that the dividend isn't enough, never should be enough. And it's a reminder, even when a lot of cash gets paid out, you can still lose money. At the moment, Fortescue shareholders who bought at 26 are sitting on a reasonable loss. Mate, thank you for sharing your thoughts on Fortescue. It's going to be remarkable times ahead. We do normally, just to confirm, we do normally look out 3 to 5 years from this point when we think about our recommendations. We're long-term investors. Well, I'm not asking you to give a formal recommendation. I'm going to assume from what you said, you expect it to underperform the market over the next 5 years. Is that right?
I think so. I think potentially the price of Fortescue stock could actually be lower from here within 3 to 5 years. But I don't know for sure. But it's so volatile, and the underlying drivers of the company are more or less out of its hands. So it's something I don't necessarily like when investing. So I take the view that there's a lot of things I don't need to invest in, and this will be one of them.
That's a really nice summary, mate. I think, look, viewers, when you think about companies like Fortescue, as Ed's already pointed out, really important to think not just about the past. We know the iron ore price has been sky high. We know Twiggy runs a spectacularly great operation, or at least the management team there is now executive chairman, of course. We know that the business itself is doing really, really well. So that's all positive. But there's only so much you can do in a geopolitical world, in a commodity world, where the sale price is completely out of your control. I don't even know about the African iron hub being developed. So thank you for sharing that with us, because, as you say, it doesn't take all that much to swing the supply and demand equation meaningfully. Even without that, I'm going to say, mate, that if you can get it out of the ground for 13, you're selling it for 100. There's a lot of profit there for more supply to be profitable, even if the ROI, as you say, isn't the core reason for being. There's just simply so much opportunity there for someone to say, well, I can produce it at $50, $60, $70, $80 a tonne, so why wouldn't I? Now, maybe that'll never happen, but the laws of supply and demand are pretty clear, and they tend to be reasonably, if you excuse the pun, ironclad. Laws of supply and demand. At some point, either demand falls because prices are too high, or supply rises, or both. And that's a really challenging one. You've kind of got to, if you're going to invest, you've got to take a view out those 3 to 5 years, as you say, and think about what the price might be based on all these different component parts. I say maybe the share price doubles, maybe it halves. We're not going to be predicting short-term share price movements, but long-term, your view, and I think I agree with you, is that it's going to be a tough one to predict. So even if you have a strong view, you're going to have a really strong reason for that strong view. And that's the one that's hard because we are dealing with massive amounts of uncertainty.
Absolutely.
Ed, thank you, mate, for coming in on your holidays. I really appreciate it. I do feel guilty. I did offer last week for you to give this one a miss, but I know you chose to come in. So we really appreciate you joining us for this Stocks in Focus on Fortescue Metals. If you have any thoughts, I mentioned earlier, please get in touch with us on the socials. You can get us on Twitter or Instagram. Now, Ed, you're not on Twitter actively, are you? Is that right?
No, I'm not.
All right. So if you're on Twitter or Insta, hit me up at TMFScottP, or hit the Motley Fool up at the Motley Fool AU. If you're on Facebook, you can simply jump on Scott Phillips Money or the Motley Fool Australia. If you want to send us an email, you can do that, info@fool.com.au. That's an email address to use, or hit us up on the socials. If you want us to cover a company we haven't yet, by the way, we've covered heaps, absolutely heaps, and you can find those. Just go to our homepage, the Motley Fool Australia, just search that on YouTube. You're here now, so you've obviously found it, and just go to the search bar on the channel, and you can look up Stocks in Focus or just a name of the company. There's also a playlist on our homepage for all the stocks in focus and all the stocks of the week we've covered. It must be up to, I'm going to say, maybe 20 by now, maybe even 24. So have a good look at that. There's heaps of companies already covered. Plenty more to come. So please do like and subscribe to the channel. Hit the notification bell so that if your company comes up next, you don't miss it. We want you to make sure you do that. While I'm here, quick ad. If you're a podcast listener or you haven't yet started, you should jump onto Motley Fool Money on your favorite podcast app, or The Good Oil with Scott Phillips, our brand new one. The most recent interview was with Ruslan Kogan, who did a spectacular job talking about the Kogan business, and I should disclose I own shares while we're here. So just keep that in mind. But a really, really great conversation, some really great free content from the Motley Fool, including this wonderful video with Ed, who's taken you through the pros and cons and a bit of a watch out. Don't just trust the historicals when you're investing in Fortescue. On behalf of Ed and myself and the whole Motley Fool team, we'll see you next time. Fool on.